Netflix has been one of the best performing stocks in the entire market over the past 20 years. From 2002 to 2021, the stock returned nearly 170,000%. And even after falling from its 2021 highs, it's still up roughly 60,000%. This means that a $1,000 investment in Netflix stock in 2002 would have turned into roughly $600,000 today. Netflix is also currently in an over 60% correction from its all-time highs that it set in last year, which is leaving investors with the question of if the stock is a buy now. Netflix reported their third quarter earnings results yesterday, and the stock responded well by being up about 13% today. In this video, I want to go through Netflix's most recent earnings and do my best to answer the question of if the stock is a buy now or if investors should be avoiding it. So what I did is I went through Netflix's recent earnings results and I took a bunch of screenshots that I want to share with you all today. Now, the first one is simply just the company's income statement. And we can see that the revenues are up year over year. They generated about $7.9 billion in revenue in the most recent quarter. And last year for the third quarter, they generated about 7.5 billion. So that is why I am saying revenues are up year over year, but revenues are down quarter over quarter. So that is definitely something to pay attention to. Now, what we can also see is that Netflix's cost of revenue is increasing with the overall revenue, and its expenses are also increasing with the overall revenue as well. Netflix's expenses are increasing at a faster rate than the overall revenue, and we can take a look at the operating income right here. And we can see that the operating income is down quarter over quarter, and it's also down year over year for this one quarter that they just reported, and also for the first 9 months of the year. In the first 9 months of 2022, Netflix generated about $5.08 billion in operating income, and last year they generated about $5.56 billion. So operating income is down regardless of the revenue being up year over year. That is definitely something investors should pay attention to. The last line here on their income statement that we want to take a look at is the net income. And they reported about $1.4 billion of net income this quarter. And this is down quarter over quarter and year over year, mostly led by, the operating income actually being down. So that is something that we do want to pay attention to, is the net income dropping. Now, the next screenshot that I have right here is of Netflix's cash flow statement. Now, how the cash flow statement works is it always starts with the net income, and then the business removes all of the non-cash expenses or adds back in non-cash expenses to the cash from operating activities to show you the actual amount of cash flow that the business is generating. Right here, we can see that the cash flow statement starts with the net income of about $1.4 billion, right? Well, then we can see that they have additions to content assets, and they subtract about $4.6 billion from the cash flow statement because of that. This is because Netflix added $4.6 billion worth of content assets to their net income. That isn't an actual cash inflow to the business. It's just the business's asset value increasing because their content value is increasing, and that is reported towards net income. However, again, since this is a non-cash boost to net income, it is subtracted from the cash flow statement. However, then we can also see the amortization of content assets was about $3.6 billion. So Netflix's content assets lost about $3.6 billion in value this quarter. So they add that back into the cash flow statement. I know that this is all kind of confusing. Cash flow statements are kind of hard to understand, but basically what we need to see here is that the difference in the additions to content assets and the amortization of content assets is the net amount of content asset net income that Netflix reported in the most recent quarter, which was about 900 million. Now, if we take a look at the trailing 12 months, the difference here between the additions to content assets and the amortization of content assets is about $1.8 billion. Now, to better understand what I am all saying, because this is probably gibberish, what we can do is head over to Netflix's balance sheet really quickly. And we can see right here that the content assets net, or the net content assets, is sitting at about $32.8 billion as of September 2022, okay? Now, at the end of December 31st, or at the end of 2021, the content assets were sitting at about $30.9 billion. So the content assets on the balance sheet increased by about $1.8 billion so far in 2022, which is exactly what we are seeing right here on the cash flow statement in the difference between the year-to-date additions to content assets and the amortization to content assets. So basically, since there was a net increase in content asset value so far this year, that is reported as net income for shareholders on the income statement, but it is removed from the cash flow statement. After that large ramble right there, that was kind of confusing, I know. I did my best to explain that, though, I promise. But we can see that the net cash provided by operating activities for this quarter was about $557 million, which is quite different than the net income that Netflix is reporting. We can also see that the cash provided from operating activities so far this year has been about $1.6 billion, which is less than half of the $4.4 billion in net income that Netflix has reported for the year. Now, basically what this all means is that the amount of cash that Netflix as a business is actually producing is much less than they are reporting in net income, because a lot of their net income is just their content assets increasing in value, or the company adding in content asset value to the net income. But it's not actual cash flow or cash production from the business. So investors really got to know this, because when you take a look at how much cash the business is actually producing, it's much, much less than the net income that they are reporting. Now, the last line right here is the purchases of property, plant, and equipment. And this is what is subtracted from the operating cash flow to find free cash flow. And we can see that so far this year, Netflix has had about $1.6 billion in operating cash flow, about $300 million in CapEx. So the company has done about $1.3 billion of free cash flow so far this year. So the company is generating positive free cash flow, and that is a very good thing to see. But if we head back over to Netflix's stock details right here, we can see that this is a $122 billion company. So this company is selling for roughly 100 times free cash flow, okay? That is a significant premium to pay for the stock. Now, right here, we can also see that in Netflix's most recent earnings results, they said that they are expecting to generate roughly $1 billion in free cash flow for the full year of 2022. For the full year, they're essentially expecting $1 billion in free cash flow. With the company sitting at a $122 billion market cap today, this means that the company is selling for about 122 times free cash flow. This is an expensive stock, okay? When you take a look at the actual cash flow that this business can generate, not the net income, because the net income isn't, it's non-cash earnings essentially. So when you take a look at the actual cash flow of Netflix, it's not that significant. And the price to free cash flow, in my opinion, is very, very high, even after the stock has fallen 60%. Now, the next screenshot that I have right here is in regards to Netflix's product strategy and what they're going to do going forward. So right here, this says improving our pricing strategy is an important near-term focus. To start, we're keeping it simple by offering one low-priced ad plan, basic with ads, at a price that's 20 to 40% below our current starting price. So in the US, for example, Netflix will now start at $6.99, which is the price of Stock Unlock, by the way, per month, compared to $9.99 today. The basic with ads plan will have 5 minutes of advertising per hour. So basically, Netflix is going to introduce this new plan that's a lower cost, but is going to show you ads when you are watching your content. This means that they are going to drive additional ad revenue, because advertisers are now going to be able to pay Netflix to get their ads on Netflix's platform in front of, hundreds of millions of people across the planet. So this will drive a brand new revenue stream, an advertising revenue stream for Netflix. But the company says right here, that said, it's still very early days, and since we're keeping our existing plans ad-free, or essentially intact, it will take us time to build up our membership base and associated ad revenue. So basically, someone will have to change their plan from the current existing plan of $9.99 a month and downgrade to the basic plan with ads, because Netflix is not going to do this automatically. Which means that this brand new advertising tier may start out slow, because it's going to have to either be people dropping their current existing plan, downgrading, or new users signing up for the lower tier. That is how they're going to grow this ad revenue. So it's not going to start very quickly, is basically what the company is saying. Now, if we take a look at the next screenshot right here, this talks about competition in the streaming space right now. And this says, as we've long said, we operate in a highly competitive industry. I agree. The company competes with TV to streaming, YouTube to TikTok, and gaming to social media. The silver lining is that the opportunity is very large and growing. Our 30 billion plus of annual revenue is roughly 5% of the combined estimated $300 billion pay TV streaming industry. Netflix is essentially saying that they have a low penetration rate to the overall TV and streaming industry, and they make up about 5% of it. However, this is a very competitive industry. I mean, you have Amazon Prime now, you have Disney Plus, you have Crave TV, you have HBO, you got Warner Media entering everything. So there's just a lot of different streaming platforms out there now. As someone who has these streaming platforms, I honestly am getting to the point where I'm like, okay, do I want Netflix this month? Do I want Disney Plus this month? Like, what show is coming out? Which subscription can I cancel right now? Like, it's really just getting super competitive. And for anyone trying to save money, you're probably going to be a lot more selective on the streaming platforms you use. And that could be even more competitive in the future. Now, moving on, it says, as it's become clear that streaming is the future of entertainment, our competitors, including media companies and tech players, are investing billions of dollars to scale their new services. But it's hard to build a large and profitable streaming business. I agree. This is something where you have to spend literally hundreds of millions of dollars into content just to get, users to come to your streaming service. Like, streaming platforms have razor thin margins, as we saw with Netflix hardly generating any free cash flow, even though they're generating $30 billion in revenue. Their free cash flow margin is something like 3%. Now, finally, at the bottom here, it says, our aim remains to be the first choice in entertainment and to continue to build an amazingly successful and profitable business. So it does sound like the company is wanting to focus more on cash flow generation in the future. Now, another interesting screenshot that I took is the Dahmer series that came out on Netflix. This is the mega trend that is going on right now, versus Rings of Power and versus House of the Dragon. House of the Dragon is the Game of Thrones series that is streaming right now, and Rings of Power is the Lord of the Rings series that is coming out from Amazon, or actually it's finished now. And both of these shows are awesome, by the way. I'm watching both Rings of Power and House of the Dragon. I haven't watched Dahmer yet, but Rings of Power and House of the Dragon, personally, I think are awesome shows. I think I like House of the Dragon better, but Rings of Power was still pretty sweet. But yeah, I'm going off topic here, but the main thing is that the Dahmer series, it has a lot more interest on Google Trends than these other two platforms. So it does look like Netflix is still releasing content that is going viral around the world. Now, the last screenshot that we got to take a look at is simply just Netflix's Q4 forecast, all right? And it says, for the fourth quarter of 2022, we're expecting revenue of $7.8 billion with a sequential decline, essentially a quarter-over-quarter decline in revenue, entirely due to the continued strengthening of the US dollar versus other currencies. On a constant currency basis, this equates to 9% year-over-year revenue growth. The company basically, on a constant currency basis, if the US dollar wasn't so strong right now, it would be a 9% year-over-year revenue growth. So the revenue in reality is probably still growing. And this further says, our revenue growth forecast is driven by our expectation for 4.5 million paid net ads in the fourth quarter and ARM growth of 6% year over year, excluding FX changes. So they are expecting to add more customers and more subscriptions in the fourth quarter. The amount of people that they're adding year over year is down from the fourth quarter of 2021, and they are expecting revenue in reality to drop over the next quarter. Now, I did the calculations before I made this video, and they're basically expecting $31.6 billion in revenue for 2022, and this will be about a 1% revenue growth year over year. Now, if we head over to Stock Unlock here really quickly, and we go over to Netflix's income statement, we can see that Netflix's revenue growth is really starting to slow down. If we switch over to the quarterly, we can also see that it is starting to slow down. And if we turn on Netflix's revenue growth rate, we can see that the growth rate is starting to downtrend as well. And they're basically growing revenue at like 1% quarter over quarter now. And they are expecting next quarter to actually produce a revenue drop. Now, also, if we quickly go and take a look at Netflix's cash from operating activities, we can see that it is only sitting at about $704 million in the trailing 12 months. So again, this company does not have a very high free cash flow margin or even operating cash flow margin. In the trailing 12 months, their operating cash flow margin is sitting at about 2.27%. So the company doesn't generate that much actual cash flow. And that is why I don't want to own this stock. I don't know if Netflix is actually going to be able to generate a ton of free cash flow in the future. And I don't love that a large portion of their net income or their earnings is made up from non-cash additions, just from their content increasing in value. So if you are considering Netflix stock, Those are some serious things you should consider. Let me just compare Netflix to another company in a similar price range, all right? Netflix has a market cap of about 122 billion. Adobe currently has a market cap of about $137 billion, okay? If we go to Adobe's financials here and we go to the income statement, we can see that Adobe's revenue is growing very nicely and consistently. In the most recent quarter, they just had another record high revenue quarter. And if we go to the company's free cash flow in the trailing 12 months, their cash flow is growing nicely and consistently. And this company generates like almost $8 billion in free cash flow a year now. And the company is expecting to grow its revenue by 10% next year, including FX changes, okay? So including FX changes, Netflix is saying their revenue is probably going to decline or be flat next year. And Adobe is saying, hey, even including FX changes, we're going to grow revenue next year and we're going to grow free cash flow. So this business is priced almost the same as Netflix, but it's generating billions of dollars more in cash flow, and it's got a price to free cash flow now of about 19.25. Full disclosure, I own Adobe shares, and that's why. This business is just much more profitable. I think that it's got a much more clear runway for future growth and for runway for future profit growth as well with cash flow. And it's got like the same market cap. So I just think that when I take a look at the amount of cash that Adobe can return to me versus the amount of cash that Netflix could return to me, the choice is very clear, and Adobe can return much, much more cash to me as a shareholder, and they buy back shares and can do whatever they want with that cash flow. So that is why I personally would rather own Adobe. And that is why right now I am not considering Netflix, because the company just doesn't generate any cash, and it's selling for like a 122 price to free cash flow, even on their 2022 full year numbers. So if you're going to consider Netflix, just really consider the fact that the company doesn't really generate that much cash, and it's in a very, very competitive industry. That is, and competition is just heating up in my opinion. So that's kind of my opinion on Netflix. That's my reasoning with the stock. If you enjoyed this video, then as always, please remember to leave a like on it. And if you're new here to the Stock Unlock channel, then make sure you subscribe to the channel to see more content like this. Also, if you are interested in our Stock Unlock platform, you can go and get a 14-day free trial by just entering in your email over at our website at stockunlock.com. You can come and play around with the entire platform, check out all of our features, and I can guarantee you that after 14 days of using Stock Unlock, you will become a better investor, and you'll probably improve your own investing and your portfolio. Also, we are announcing a brand new subscription newsletter. If you are a paying member of Stock Unlock, then you will get an additional newsletter of all of our favorite stocks and in-depth stock analysis so that you can find new companies, find new stocks, and grow your own stock analysis in the process as well. Again, that will only be sent out to our paid subscribers. So if you want access to that new newsletter that we are working on, then you have to be a paying member of Stock Unlock. And that's another way that we're going to be adding value to you. But that's going to wrap up the video, everyone. So thank you so much for watching. We truly do appreciate it, and we really hope to see you all again in our next video.